Okay, normalizing monetization. Kind of thought about this topic because over the last several years, the idea that MMT is the same thing as monetization became sort of the definition of MMT by everybody who isn't MMT. Which it seems weird to me because it kind of seems like the way the neoclassicals are to Keynes, where Keynes is sort of the innovation he had apparently was a fixed wage model, which if that's all he was going to do, he didn't need a 400-page book, right? They kind of already understood that by then. Same thing with monetization. So we didn't need to name it MMT. We already had a word, monetization, right? So obviously that's not necessarily what we're saying. So what are we saying? This is what I'm not saying. Monetization through government and central bank cooperation should be how government deficits are financed as a general rule. This is the sort of doing MMT that people incorrectly assume is what we're talking about. What I'm saying is whether deficits are accompanied by bond sales or monetization, for the most part, is not important if we understand what monetization is versus what it isn't. So if we normalize monetization, what I'm referring to is recognizing that it is normal in the sense that it already happens all the time and without the consequences we were told to fear. So if we accurately incorporate it into models and theories, we should then end up mostly indifferent to how deficits are financed in the real world. Do economists understand monetization? You might already know where I'm going to go here. So in the real world, and Randy went through this in his 1998 book, so it's, but we're still here trying to explain this. The impossibility of monetization without sterilization. So I'm broadening a definition of sterilization here because we weren't talking about a floor system prior to 2008 for the most part. But with the floor system, the sterilization comes by paying interest on reserves at the target rate. Whereas if you are running a corridor system or any system where the interest rate target is above interest on reserves, in order to continue to achieve that interest rate target, you are going to have to drain the reserves when you run a deficit. There's one economist that understands it, Coach Lakota, where he says there's absolutely no economic difference between the two forms of financing. Right. In the first case, Treasury pays interest. In the second case, the Fed pays exactly the same interest. The crucial point is there's no need to employ helicopter money because it's not really a thing. It's just one entity, one government agency running the deficit or issuing the liabilities and paying the interest instead of a different one issuing the liabilities and paying the interest. So this is going to be quick here, but there's a point to it. And you guys have surely seen this by now, but when the government runs a deficit that creates a surplus in the private sector, of course, when they do that, they do it by crediting bank account reserves, and the banks then credit the recipient's deposits. Whether you issue bonds afterwards has no effect on the fact that you created net worth for the private sector. That is the thing that matters, not the financing. I'm going to come back to that one a bit later. And if the government isn't the one that issues the liabilities, somebody else will have to do that because that is operationally necessary to achieve the central bank's interest rate target. Again, this was all in Randy's book in 1998. Okay, so let's go to the way that we hear it from the neoclassical side, which they actually get to the correct conclusions, but they do it incorrectly or for the wrong reasons. We'll say it that way. So they tend to look at it two different ways here. Like I say, view A, view B, where you are either, they got it correct that you're shifting the supply curve on reserve balances to the right, But in view A, you've raised the interest rate target up, or interest on reserves, to be equivalent to the interest rate target. And that will stop money in its tracks, printing money in its tracks, or you've allowed the interest rate to fall to zero. And you're running a zero interest rate policy, and that will also stop printing money in its tracks, because the interest on so-called money is the same as the interest on bills. And so instead of printing money, you're actually printing bills. And that's the case, and that's what's going on in both cases from their perspective. People need to quit doing that. Anyway, the point here, though, is from their own perspective, these two things stop the effects of money printing from being more than the effects of running a deficit and issuing bonds. But those are the only two ways operationally you can print money when you run a deficit. So hopefully you're kind of squaring the circle on that one in your own mind, right? And, you know, we don't need any more proof of this than Paul Krugman, who's always right and never changes his mind. Where he says, right, he's got his lower bound, his liquidity trap. It's Krugman's liquidity trap because it has nothing to do with Keynes's liquidity trap. On the left, I've got a quote from the New York, some researchers at the New York Fed, who also seemed to think that there was a money multiplier if we didn't pay interest on reserves, which is sad. But so there you go. See, Krugman recognizing both of those stop printing money in its tracks. So I had a little debate, I guess you call it, with Simon Wren-Lewis a few years ago on Twitter, where he says, if interest rates are zero, you can create as much money as you like with no effect, right? Zero interest rate policy, view A. But at positive interest rates, there has to be a relationship between high-powered money and interest rates. And I said, well, no, Fed's doing that right now. And he says, but you can't determine both quantity and price. Of course, guess he hadn't heard of a floor system by 2018, which is kind of interesting itself. But so I just reminded him of the floor system. So then he says, in that case, with reserves included in definition of money, the simple liquidity preference story does not work. But does that matter, as reserves are now costly for the consolidated government? First off, notice that he said consolidated government, right? And I waited around for a few days just to see all of the MMT haters come in and hammer it for using the term consolidated government, but they never did, because they only like it when we use it. Or they only don't like it when we use it. So as I pointed out, right, those are the only two ways you can print money. In the new Keynesian model, those are both cases of liquidity preference doesn't work, so bonds versus money doesn't matter even in their own model. For the wrong reasons, but it doesn't matter nonetheless. But still, they think that there's some sort of money printing thing going on here beyond those, which is really awkward and odd. And so we go to Galli's paper that is quite popular in the neoclassical monetary theory, came out a few years ago. And so we find the answer there. When the zero lower bound is not binding a money, so he's saying you are running a corridor system, okay, not a floor system. A money finance fiscal stimulus is shown to have much larger multipliers than a debt finance fiscal stimulus. So we're still back to the point of what on earth do they think is happening? Unless they're violating the laws of supply and demand. I mean, think about it, right? You've got supply and demand. Just think of the graph in your head and you shift the supply curve way off the entire graph, right? What happened? Price fell to zero, right? The only way you can keep it from falling to zero is if you put a floor in, right? But they're saying we don't have a floor, but we shifted the supply curve all the way to the right and we still have the price above zero. How did you do that? I don't know. We get a little bit of an answer from, I always go back to this from 2011 from Scott Sumner, where he explains how he says that we aren't going to get anywhere if we keep talking about interest rates and reserve requirements and bank reserves. I'm talking about changing the monetary base. I'm talking about doing so in normal times when rates are above zero. So let's ignore the banking system and assume the Fed buys 100 billion in T-bonds from the private non-bank sector. They pay for the bonds with currency. Well, there you have it, right? You get there if you assume a world with no banks. That's how it works. So just as we assumed, or just as we thought, they were analyzing a world that doesn't actually exist. So, okay, do you know the middleman? Popular myth is that this is how deficits happen. Private savers lend money, purchase bonds from the US government, or whatever government, and the government spends. That adds reserves to domestic banks, and they add deposits to their recipients' accounts. At the margin, in reality, what's happening, though, is that the central bank in a liquid market is lending to the dealers that are at the margin buying the government bonds. And so this is the thing. If you're talking about a liquid market, you have to bring credit in, because that's what is happening in the first place. You've got credit creation in a liquid market because you are affecting the price in terms of market liquidity, in the sense that whoever comes, however much trading goes on, market liquidity is defined as somebody can go in and sell a whole bunch of bonds, and that doesn't move the price away from some fundamental or some arbitrage condition. That only happens in the real world if you're involving credit. And if you're involving credit, then for it to continue, you got to have a backstop. Well, if we're talking about treasuries, we're talking about the backstop being the central bank, because the treasuries are at the top of the hierarchy of liquidity. And a little more on that later. So if you're thinking about, well, who's going to buy the government bonds, and you're assuming a liquid market, you're already wrong, unless you put credit in there, endogenous credit creation. Okay. Well, we can see this if we think about the taper tantrum about 10 years ago, where the Fed talked about slowing down its quantitative easing purchases. Didn't slow them down, but talked about it. And we can see that the short-term interest rates there didn't move. The long-term interest rates increased, right? Intermediate long-term interest rates started to increase. So the taper tantrum shows which of these is true. How's that? Well, these two things cannot simultaneously be true. Quantitative easing shifts the supply of loanable funds, or if you want to talk about the demand for bonds, either one, it's going to have the same effect, which reduces the interest rate on government bonds. Can't have that happen and also have a taper tantrum. Those two are internally inconsistent, logically inconsistent. You can't have both of those happen. Why not? Because a taper tantrum means the interest on government bonds rises despite the quantitative easing operations. Fed didn't slow down its quantitative easing, but the interest rate increased. So how was quantitative easing reducing interest rates? Well, it probably wasn't, beyond what the markets were expecting the Fed's target rate to do. So in other words, available market and funding liquidity is far greater than quantitative easing operations. And the minute that the markets expected higher interest rates in the future, they kicked in and raised interest rates. So what we really have is a hierarchy of liquidity there, where treasuries are among the markets at the top of the hierarchy of liquidity, and they are backstopped by banks, and they are backstopped by central banks. The banks themselves are backstopped by the fact that central banks setting an interest rate target. Again, you got to bring in endogenous credit money creation to understand that. Okay, so the reality is printing money just cuts out the middleman rather than adding jet fuel to the deficit. So standard practice is on the left. This is what we do in normal times. Government runs a deficit at the margin. The primary dealers are being financed by banks, and then if they need to, by the central bank. On the right is printing money. You just cut out the middleman. That's all you did. If we monetize and no one hears it. So Philippines, during March through April 2020, they did a 300 billion, sorry, their central bank did a $300 billion Philippine peso repurchase agreement with the Bureau of the Treasury. Nobody batted an eye. A little bit later, they paid an advanced dividend to the Treasury. These were both just printing money. right? They just credited the government's account. The government spent. Later on, the government might issue bonds to create the credit in its own account to pay it back. But it was a case of spending first, issuing bonds later, for sure. United Arab Emirates and Saudi, this goes for Saudi Arabia and others like that. When they sell oil and receive dollars in exchange, I got a simplified version of what was on the other slide here. On the left, they receive US dollars. On the right, they credit the government's account, but it's in a different currency, right? And the government spends, which adds to bank reserves. That's what's going on the right. What I don't have there on the left is what does the central bank do next with those dollars? They invest them in US treasuries. They send them to their sovereign wealth fund and invest them in equities and such. It's just crediting the government's account and sending the money somewhere else. Singapore says, well, we don't issue bonds the normal way everybody thinks of issuing bonds because they're unrelated to our fiscal needs because we never run deficits in Singapore, right? And Singapore is, most people would think of, you wouldn't think of Singapore if you thought about a government that is threatening its credit rating, let's say. You wouldn't equate them with Greece or anything like that. Okay, so we issue securities to develop a domestic market. We issue securities so people have savings, et cetera, not to finance government. Well, the reason why they do that is because they're printing money like crazy. And they do it under the guise of the net investment returns contribution from the national reserves, which they never tell anybody how big the national reserves are. Okay, they have two sources. They can take up to 50% of those sources of net investment income and net investment returns. I'm going to start with net investment income. So net investment income is basically like what I just showed you with the United Arab Emirates. Foreign currency and interest, dividends, et cetera, comes back to the central bank. Central bank credits the government's account in the domestic currency. They spend. The central bank, could be some combination of government and central bank, issue bonds to drain the balances, and they reinvest the dollars. Right? The even better one though, well, first off, and then the central bank reduces remittances, so it's the government that ends up effectively paying the interest on those bills. Okay, that was T accounts. I must get the T accounts. Net investment returns, this one's even better, because there's no cash flow at all. They just say expected real long-term capital gains of the National Reserve. So they say, well, we think over the long term, we're going to earn 10%. Oh, okay. Well, let's put half of that in the government's account. That's literally what's going on here. So they credit the government's account. They spend, they issue bills to drain it, reduce remittances. That's it. So this is exactly the same as the one by United Arab Emirates and their net investment returns, except there's no actual cash flow here arriving. They just say, well, the returns will be in the future this much, so we credit the government's account this much. Right? So printing money happens all the time in the real world. Economists don't understand accounting operations well enough to know this. This also means they don't understand that printing money isn't its own thing. It's just a different, as I said before, government agency issuing debt at the central bank's target rate or roughly equal to it. Maybe good economists don't know this because they freak out. But it happens all the time and it's not inflationary on its own. Maybe we should reconsider our theories, just saying. What if we mint the coin? What does that one look like? Right? Oh, it's supposed to be massively inflationary, right? Well, US mints $1 trillion coin, credit treasury's account, government spending, Fed sells bonds, pays interest on reserves in the floor system, reduce remittances. Looks a lot like what Singapore's doing. Anybody think anybody criticizing Singapore? Right? This is actually less inflationary than Singapore, because Singapore does it in order to spend more. Mint the coin is not about spending more. It's about getting around the debt ceiling so you can spend what you already passed in the budget. Okay, who really wants market discipline? This is from Indonesia's central bank law. And I want to focus on that third point right there. Sorry, is it the third or the third? So they're basically talking about what to do with the central bank's profits and how they're going to be sent back to the government. And in number 3, they say, well, in the event that after measures referred to in paragraphs 1, etc., the capital or equity of the Central Bank Indonesia is less than 2 trillion rupees, which, I don't know, 15,000 to the dollar, I'm not sure. Last I checked. Anyway, government shall be required to cover the deficit after approval from the House of Representatives. And most countries, if not all of them that I've looked at, do the same thing, right? That if the central bank's equity gets below 0, they'll be recapitalized by the government. Well, why would the central bank want the government to be subjected to market discipline then? Would you want your backstop to fail? Probably not, right? And when I presented this in Indonesia, and there were some policymakers from the central bank there, so I made sure I put in big letters what was going on. Anyway, okay. So, and lots of people have said this next one, I just knew that I had said it, so I put it here. It's clear enough. Another reason why the central bank wouldn't want market discipline applied to government debt markets is because the yield curve for the risk-free rate is a benchmark to use for the pricing of other assets, meaning it is part of the transmission of monetary policy into the economy. It's also part of stability of the financial system. So there's 2 primary reasons then for a central bank to support government liabilities. Reduce the yield curve below market expectations if the market expectations aren't low enough. This is what was attempted with QE, probably successful with yield curve control. Or to support market functioning where liquidity is insufficient. That's probably what the Philippines was doing. Okay. Oh, forgot I had the Philippine slide about where they entered the market. I talked about the money printing, et cetera, before, but they entered the market a couple of times to create more liquidity because they didn't have a liquid enough market. And then they received Asian Development Bank loan to improve liquidity in their financial markets. So China, a former member, I can't say these names, so I'm not going to try, but former member of the Central Bank Policy Committee. Currently, Chinese government bond market has plenty of room for government bonds. If there's a problem with market liquidity, central bank will buy and sell government bonds in the secondary market to provide liquidity. Biggest advantage is that it can form the yield curve of government bonds, provide a risk pricing benchmark. Right? So basically said both of the points, right? Why would we do it? Well, if the yield curve is not low enough and we want it lower, or if the market's not functioning because it doesn't have enough liquidity. They were getting pressured to do monetization. And they were saying, we don't need to do monetization because the 2 reasons we do monetization aren't a problem right now. In reality, there are only 2 choices. We were talking, there was some discussion this morning about what's going on with US Treasury markets and some problems that have arisen. There are only 2 choices. You can have the central bank run the government debt markets itself, issue reserve balances or its own liabilities. Equal to at the very minimum any bonds the government wouldn't sell at the central bank's desired interest rate. That enlarges the central bank's balance sheet permanently by similar to the size of the national debt. Or you can continue the traditional illusion that there's such a thing as price discovery in government bond markets, while the central bank still implicitly backstops these markets at all times, in addition to any repurchase or open market operations in government debt set to the interest rate target. This is the pre-Basel III world. This is before we started to get some of these newer regulations, where there was never really a crisis in a liquid government debt market. It was everywhere else when it went into crisis, it went into the government bond market. And that was the safe asset. But now we are having crises in government bond markets. So what's going on is they're attempting a third choice, and the outcome's pretty predictable. So due to these new liquidity and capital requirements, banks are limited in how much they can support government debt markets, including funding liquidity to dealers. So attempts by central banks to normalize balance sheets to pre-COVID, pre-global financial crisis sizes exacerbates this. They push greater responsibility for dealer funding and liquidity onto banks. So at the first sign of any disruption, funding liquidity from banks into repurchase markets for dealers dries up. Central banker intervenes quickly with market functioning operations, takes a large part of both markets onto its balance sheet. When the crisis ends, central bank tries to normalize its balance sheet. People start to view these market functioning operations as support to government, rinse and repeat. So the result is we have regulations say don't buy government debt. So when the crisis comes, everyone wonders why banks don't buy government debt. So the central bank has to step in again because financial stability and interest monetary transmission. In the interest of time, I'm going to speed up there. Can we push this still further? Imagine if government spending occurred through loans by the central bank to recipients and then the central bank canceled the loans. We'd only have reserve balances created that earned interest on reserves. Reduction in remittances would leave governments effectively paying the debt service, but you wouldn't issue any government bonds. Would you worry about the national debt? Where would it be? Whose is it? Go a step further. Recognize that bank solvency is something that's regulatory or legally determined. There's no sure thing as an insolvent bank. What if the government spending occurred through banks crediting customer deposits? Then regulators let them record this as a negative liability rather than a decline in equity. Might have to subsidize because the banks would have some additional interest they'd have to pay on their liabilities because they'd have to fund the outflows when people spent from those accounts. But it'd be kind of like a smaller number than current debt service. Would you worry about the national debt? Where would it be? Okay, conclusion. Let's remember again why we have deficits in the first place. Oh, I thought somebody was writing up there. Okay. Jason Furman, one of my favorites. Our fiscal goal should be a gently declining, he says that like, gently declining debt to GDP ratio. Requires deficit average about 3% of GDP over the cycle. It should be better than that when growth is strong, blah, blah, blah. What are the implications for the path of the private sector's balance sheet, financial balance? If you do that, while following whatever you think is the most likely path for the current account. Of course, I'm asking him about the private sector financial position. And shockingly, there was no response. So maybe because I thought I was nobody, but you might be right. But anyway, okay. But normalizing monetization and monetary theory, even in their own models, deficits with monetization isn't more inflationary than a deficit with bond sales. A liquid market for government debt means the central bank intervenes implicitly or explicitly, whether you don't need monetization for that. You've got the central bank already creating endogenous credit. So monetization already happens all the time. Central bank has no interest in disciplining government in its own currency. If we understand all of this, we can think of monetization as just another standard normal choice along with bond sales and even more creative alternatives. And that's a better approach to monetary theory. And that's the more along the lines of what MMT means when in general, rather than saying MMT equals monetization. All right, that would be closer to doing MMT. Okay, that's it. Thank you.